Okay, hi guys. Welcome to today's webinar. Hopefully everybody's in here. Can I get a sound check? Can somebody just type something in the chat box to make sure that you guys can hear me out there? All right. Looks like we're good to go. Okay. The webinar today is it's called Strategies for Trading Commodity ETFs. My name is Brett Manning. I'm a senior analyst here at briefing.com. I post under the ticker chart and ETFXX, and I go by chart trader on the website. Now, before we get started, I just want to say we've had a lot of volatility in the last couple days, particularly in the commodity space. So, a lot of the charts throughout this presentation, I put together this PowerPoint over the weekend, so they're not all going to be reflected, but I want to stick to the logic that I set up here so that I really get the points across that I wanted to. This is really more of a big picture and mechanical kind of presentation. Really, I want to get to where I feel like I have imparted something that I've come to understand about how these things work underneath the surface, and there's some huge opportunities written into that. So here we go. The basic gist here is really, as I just said, understanding commodity-focused ETFs and how they work under the surface, and a big part of that is understanding the mechanics of futures exposure, accounting for the forward curve and term structure of a commodities market, because you really have to do that to understand what's possible with these ETFs. And that means we need to get into Contango and backwardation and how that all plays out, and the different structures and how they utilize this. And also accounting for leverage, because a lot of these ETFs that you're going to be interested in for the commodities complex are going to be leveraged, and there's a really strange mathematical phenomenon that goes on here, and I can explain to you exactly how that works. And I think it's really important. And again, this leads to real problems on the one hand, but it also leads to real opportunities, and so I hope to really be able to show that. And, as I said before, this is really a big picture kind of overview, not so much about day trading commodities as much as it is about understanding how commodity ETFs work into the big trends and big trades in the commodity complex. And, we're definitely going to take a look at where we stand and at the commodity complex bear market, and, understanding the logic that's driving that bear market, and take a look at maybe where we are right now and hopefully where we're headed. And also some strategic ideas for how to make use of commodity ETFs to take advantage of what I see ahead. And, there's some really interesting opportunities there. Okay, so first off, just looking at the commodity ETF menu, I just want to say among my goals today is not the goal of listing and itemizing the universe of possible commodity-related ETF choices. You can just use Google for that. There are tons of great resources online that will break down the available universe of commodity ETFs. There are hundreds and maybe even thousands of them out there. And, really what you'll find is they're all pretty much the same. You can break them down into just a few different groups. All right, so the most prominent, the basic unleveraged serial futures holding, and we'll get into kind of what that means in a minute. Most of them are this. They buy one futures contract, they sell it, they buy the next futures contract, they maintain a level of exposure, trying and failing to represent what's known as the continuous contract. And then, a smaller number of them are leveraged versions of the same thing, which make use of various swaps contracts to lever up and amplify the effect of them. And these work well. However, they do what they're supposed to do. However, most people don't realize exactly what they're supposed to do, and so we'll get into that as well. And then finally, there are this new breed coming out, the so-called Contango killing ETFs, which actually don't work. And I'll tell you what Contango is in a couple minutes and exactly why they don't work. Okay, so let's just dive right into the nitty-gritty here. All right, the first and most important thing to understand is that when you're trading a commodity ETF, you are trading futures. Now, when I say commodity, I'm not talking about stocks that are in the commodity sector. An oil driller is not a commodity. A gold miner is not a commodity. If you own GDX, you do not own gold. So when I say a commodity, what I'm talking about is a fungible good, or something for which there is demand, but which is supplied without any qualitative differentiation across its supply base. Oil, gas, gold, silver, copper, wheat, corn, etc. So as I said, if you buy a commodity ETF, you are buying futures contracts. So that's why we need to understand how commodity futures translate into ETFs and what's meant by the forward curve and terms like Contango. We also need to cover how leveraged ETFs work because so many of the commodity ETFs you're going to want to focus on will be leveraged. And as we will see, the combination of these two issues, the forward curve and leverage, is why something like UCO, the leveraged long crude oil ETF of choice right now, could possibly have underperformed crude oil by 90% over the past 5 years. There is a reason. It's not broken. It's working perfectly. Okay, so starting with the futures issue, futures markets, as most of you probably know, are traded in contracts that expire at a predetermined time. It's usually monthly, bi-monthly, quarterly. That means a futures market is really a bunch of different markets. For instance, there's March copper, and there's June copper, and there's December copper. Right now, we're trading March crude oil. That contract will expire in a few weeks and give way to April crude oil. The range of different prices for futures contracts at any given time is called the forward curve. But if we link them all together in sequential order, you get what's known as the continuous contract. And that's really what we think of when we think of a commodity market in terms of its price history. Right? So, for instance, this is a chart of crude oil over the last 10 years, right? And it looks like it's one market. Here's crude oil. But really, that's linking a lot of different markets together. And there is no way to have owned this. This object right here is impossible to own. Right? You can't buy the continuous contract. I mean, I guess the only way that you could theoretically get the same result as this is if you owned a bunch of barrels of crude oil. I mean, maybe you could sit them around your apartment, use them to hold up your dinner table. That's about it. Otherwise, if you own March crude oil now and you want to own crude oil, let's say you bought crude oil, you want to own it for the rest of the year. You want to own crude oil in 2015. Right now you'd own March crude oil, and unless you want that big barrel in your living room, you're going to need to sell March crude oil in a few weeks because otherwise you'll have to take delivery on it, right? So you don't want that. You want to sell it before it expires and transfers into actual crude oil. So you sell it in a few weeks, and then you got to buy April crude oil. And that's where the real problem is, right? Take a look at this chart. So if you sell March crude oil and buy April crude oil, they're not trading at the same price. I mean, this chart right here, it shows a range of contracts to the end of 2015. Notice how each contract of a lighter shade, which represents a more distant expiration, is trading at a higher price. So June is above March, September's above June, December's trading above September. In other words, every time you have to sell one and buy the next one, you're paying a higher price. So if the price of crude oil jumps higher because of these jumps in expirations, it's the continuous contract that's jumping higher. But you're going to be selling one contract at X dollars, and you're going to be buying it back at X plus $2. Right? So as far as you're concerned, you're missing out on those 2 units of profit. And that's what's called Contango. Simply put, Contango is how we label a forward curve that consists of successively higher priced contracts out into the future. The opposite situation is called backwardation. This is when the forward curve consists of successively lower priced contracts out into the future. If we stay with the example of the oil market, then Contango is what we have now, and what we've had for most of the past half decade or so. Backwardation was in place during the majority of the last real bull market, which was back before the financial crisis, when we had real demand growth and the booming emerging markets and no stagnation the way that we've seen over the last several years. Okay, so to sum up, ETFs are like any investor. If an ETF is supposed to own crude oil, then it has to own it in futures contracts. That means it will badly underperform the crude oil continuous contract when the forward curve is in a contango state. But it will actually, interestingly, outperform crude oil when oil is in backwardation. And take a moment to think about this for a second. If oil's in backwardation, right, if each successive contract is pricing simultaneously at a lower price, the June contract is pricing below the March contract, and September is pricing below June. That means if oil simply goes sideways from now until October, the ETF like USO, the U.S. Oil Fund, will actually go up. It will post gains because it's buying low and selling high at every contract roll, right? So you'd see a sideways crude oil market and USO going up, outperforming. But that's because of the backwardation. Another way to think about this is when there's contango, we might say that the market has a positive roll return, right? Rolling means moving from one contract to the next. At expiration, the March contract will roll into the April contract. So there's a roll return, right? If we're in contango, the roll return is positive for crude oil because the price of the April contract is higher than the price of the March contract. So the price of crude oil will actually go up based on the roll, right? So that's what's bad for the ETF because the ETF has access only to the trading returns. It doesn't have access to the roll return. It has to pay the difference for the roll, right? So one way to think about it is the ETF's return is going to be the spot return minus the roll return. Hopefully that makes sense. All right. As a result of this, because oil has been in contango for most of the past 5 to 6 years, in other words, because much of oil's strength over the past 5 to 6 years can be attributed to roll returns, as you can see, USO has lagged horribly, underperforming crude oil by a monstrous 60% in that time. And that's simply because of all the contango, right? USO is not a leveraged fund, so all of this underperformance is just because of the forward curve. Now looking forward, because we know that contango is super dominant in oil right now, we can also say, in a point that kind of ties this all together, if crude oil closes the year at about, let's say, 54 to 55 bucks a barrel, so up maybe another 10% or so, then we know that just based on the forward curve right now, roll returns will account for more than all of those gains, most likely. And that means if you bought USO right now, and then watch the price of oil rally 10% or so through year end, you would likely be, flat or down on your USO position. All right, and to wrap up this section, big point here, ETFs are just traders. If you buy an ETF, you just buy its exposure. And just like any other trader that wants to own the continuous contract, they fail at it because it's impossible. So while there are many attempts to solve this problem, and it's a great, marketing pursuit by a lot of these companies that make ETFs, none of these attempts are going to work. It's impossible, right? Except for what gold has done, GLD, right? If the ETF simply owns the physical commodity in a storage situation that's not costly, then you own the commodity. And that's, as I said, it's like owning barrels of oil in your living room, right? That's the continuous contract. Essentially, the value of the oil in those barrels is going to change with the price of oil. There's going to be no roll return problems or anything else, right? But other than that, other than something like GLD, no attempt to solve the contango problem is going to work. There are different attempts, like there's an ETF called the United States 12-Month Oil Fund. The ticker is USL. And there are other ETFs like this. What they do is they try to beat this problem by diversifying up the forward curve. So they own equal amounts of the next 12 contracts, for instance. Right? But if you look at the situation right now, for instance, that doesn't affect anything because contango stretches out through 2023. So each time a contract rolls, they just roll 12 different contracts. So there's trading inefficiencies there, but they also are going to roll up in price for every single one of those 12 contracts. And since they're rolling from one to the next of contracts they already own, they're just staying with 11 of the same 12 contracts, and they're dropping the first one and adding the last one, which is an even bigger jump in Contango, which could hurt them even worse. So in some situations this might soften the blow a little, in some situations this might make it a little worse, but it doesn't solve the problem, the underlying issue with this, that you can't own the continuous contract. All right? And in any case, it's important to understand this. If you're going to be trading these things, then you need to understand that you need to track the forward curve. And as I said a couple slides ago, when you see backwardation, you can actually profit from this issue. It can actually help you. And there's another way to profit from it, which we'll go into later, which has to do with shorting ETFs that are particularly vulnerable to this type of issue. I mean, for instance, if you had shorted UCO a few years ago, you'd be up 90% on that trade in a crude oil market that's gone sideways. That's another way to think about it. It doesn't just hurt you, it can help you. Okay? And hopefully now we've adequately covered this dynamic at this point. You guys now understand the forward curve and how it just about defines the performance of commodity ETFs. And the next thing I want to do is shoot quickly through the way that leveraging fits into this picture. This is also something that can largely define the outcome distribution of a trading plan with these types of ETFs. So we'll spend a few minutes on this, and then we'll move into the current commodity market landscape and try to get more of an understanding of the bear market that's on right now and how to think about it in terms of ETF strategies. Okay, so I don't want to spend too much time on this part, but I want to make sure you guys understand how this works. When you see a leveraged ETF, you need to understand what you're getting into. The best way to do this explanation is with a fictitious example that I've used for years, and I think it gets the point across. Let's say we have an index XYZ, and from that index, there's some financial company out there that makes 2x leveraged ETFs in both directions. So XXX is the leveraged long version of XYZ. It goes up twice as much as XYZ in any given day. And the other one is YYY, a 2x leveraged short based on XYZ. So it moves inverse to XYZ and twice as far. All right, so here's the key point. Imagine all three of them start at $10 a share on day number 1. Now let's say XYZ goes to 11 the next day. We can see that XXX would go up to 12 that day as a result, up 20%, and YYY would drop to 8. So as XYZ goes up 10%, XXX goes up 20%, and YYY goes down 20%. Now, on day 3, XYZ, let's say it trades back down to 10. Well, that's a drop of 9.1%. That means that XXX is going to drop by 18.2%, twice as much. That's going to take it down to 9.82. That's also going to pop up YYY by the same percent change, 18.2%. That's going to take it from 8 up to 9.46, right? $9.46 a share. So the big point here is XYZ went sideways. It went from 10 to 10 over a couple days. In both XXX and YYY, its levered long and levered short vehicles, ended up declining as a result. Both of them. That's the effect. All things equal, that's the effect the leveraging dynamic has when it plays out iteratively, right? And so to just really drive home the point, here's that same effect on display over 2 different price series when you draw it out a bit more. Market number 1, this is a choppy range, right? You can see it on the left-hand side. Market number 2, on the right-hand side, the context here is a big trending rally and then a big trending drop. So in both cases, XYZ goes from 10 to 10 over the course of 30 different trading sessions. In one of them, it chops back and forth. In the other one, it rallies up and then comes back down. In both cases, the leverage vehicles all end up going down significantly as a result, right? I mean, by 30, 40, 50% over the course of 30 days in a sideways market. And that's how these things actually work. That actually happens. And I'll show you a real example of it in just a second. But as a basic thesis statement here, all things equal, it's crazy to own these things in any context other than a directional one-way trade. If you do not have a market that is just going one way in your direction every day, they're terrible, terrible, terrible things to own over any period of time. But by the same token, and like we saw with the Contango example in the futures part of this, it's great to short them in a sideways or declining market. Just be careful, judge your risk right, but there's huge opportunities in these things on the short side. Okay, so here is that real-world example I was talking about. Take a look at the XLF and FAS and FAZ. This is the financial sector ETFs, right? During the bull market from late '08 to present, early 2009 to present, the financial sector is up huge along with most things. XLF is up like 65%. So here's the big question. How much would you be up if you chose correctly between the leveraged long and the leveraged short financial sector ETF? FAZ, the leveraged short, is down almost 100% in that time. That's obviously the bad choice. So obviously you want to be long the other one, FAS. Let's see how that one did. Whoops. Yeah, that's right. If you bought FAS right down in the depths of the last bear market and held it until now, you would be down 31%. All thanks to the iterative effects of leveraging in the ETF. All right, and here's a chart of that. It's almost back to even. It's working its way back. But they are both down right now. Now, if you tie these issues together, one good way to do that is to consider the ETF UWTI. Now, this is another crude oil leveraged ETF. It's a triple levered instrument, whereas UCO, which we talked about earlier, is just a double levered. UWTI gives us a good example of the combined effects of contango and leveraging, particularly if you look at over the 2 years from February 2012 to February of last year. So 2012 to 2014, February to February, the price of crude oil was perfectly flat in that time. It was mired in a tight trading range, chopping back and forth. And in that time, it had plenty of contango in the forward curve. And as a result, UWTI was down by over 40% during that period. Now, this is scary to the long-only investor, but I want to emphasize one other point. It also suggests a key strategic consideration for us traders. See, in a sideways ranging commodity with contango in the forward curve, if you short a corresponding leveraged ETF, it can pay off huge. You can define your risk easily and you can make a ton in a market that's not going anywhere just by what we might call the mechanical or structural flaws in these instruments. Okay, now briefly I want to go over where we stand right now as far as the landscape in the commodity complex and what's transpired over the last 6 months to a year, and a way to frame it in your mind, and then we'll look toward where we're headed. Okay, so right now we are in the midst of perhaps the biggest, most powerful non-recession commodity bear market in decades, and I think that when the way that this has been portrayed in the financial media, if you watch CNBC or you read the Wall Street Journal, you get the sense that this is all a bunch of sort of coincidences among these markets, that really there's been something in particular that's happened in the crude oil market. For instance, the shale producers in the U.S. Became overinvested in and overproduced. The Saudis stopped protecting the price of oil in their stewardship of OPEC as a market share grab, etc. And in copper, there's been a problem in the Chinese housing market, and in gold, there's been an issue of mismanagement in terms of the timing of uses of hedges and investment in new mines. And it's all a bunch of separate little instances. And I think this is a really classic example of not seeing the forest for the trees. Right? I mean, there's a forest here. There's a single unifying common theme that's driving all of this, and that is that several years ago, when the Fed embarked on QE2, it really marked an inflection point as far as sentiment and as far as investment in the commodity complex. This became a point when everybody seemed to just throw up their hands and say, this is going to mean the end of the dollar, and this is going to mean the one thing we can guarantee we're going to get out of this huge printing from the Federal Reserve is commodity price inflation. And over the course of the next few years, we racked up about $3.5 trillion of debt on the balance sheets of commodity producers and saw some of the biggest speculative long positions in the commodity futures markets in all of commodity trading history. And at the same time, we saw financial companies come out with hundreds or even thousands of commodity-based ETFs and promote this idea that the commodities markets are an investment class, which is kind of absurd in its own right, considering that these are mean-reverting markets by definition. So there's no growth in commodities over time. There's inflation, which is a monetary phenomenon, but in commodity prices themselves, you can't really invest in commodities. It's not going to get you anywhere. Essentially, as the equation at the bottom of the slide shows, what we have here is a tremendous amount of speculation and investment on the one hand, and something that didn't really turn out, right? The big growth in demand. This was all based on the idea that we would get a big growth in demand and at the same time a weakened dollar. And instead what we got is really low growth and a strong dollar. So we got all the speculation and investment in there. We got all the increase in supply as well as the increase in speculative positioning, but we did not get the growth and we did not get the weak dollar. So it really was the worst case scenario the way that this worked out. Now, the way that I actually ended up playing this, I started to get an inkling that we were getting this sort of situation coming together early last year. And when we started to get the taper, I realized that was kind of the end of the line for the QE bugs, as you might call them, the guys who believed that the fact that there was QE guaranteed some kind of big inflationary outcome. I realized there must be a lot of speculation in the system, and in fact I could see it in there, and so I started to go after gold first. And shorts that we had in gold in mid to early to mid 2013 where we started, we caught a couple of the crashes there, but really the big trade was last year, starting in about August, when gold failed to respond to the upside after Putin invaded Ukraine, and we got a real flare-up in the Middle East in terms of as ISIS really emerged on the scene as the new big brand in terrorism. Gold really couldn't break its trend line, it couldn't move anywhere, and that really signaled that we were going to start to the downside and really start to wash this thing out. And the fact that that was happening while the Fed was still doing some QE, really kind of highlighted the idea that we were starting to turn and roll out of the positioning for the big inflationary outcome. And it starts with gold. And we had some big trades there, made 150 points in one big trade from early September or late August to, I think it was November 3rd was the cover at about 11:45. And that was right about our target on that trade. So that was a really big one. And you can search back through the chart archive to see all of the actual transactions there. They were all traded live on the site. The next real campaign was in crude oil. Once I saw gold go, it kind of signaled that the game was on for starting to trade these things to the south side. And as you can see here on the chart, you can see that we led into this period in crude oil with what was, quite frankly, the largest speculative long position in commodities market history. The crude oil long position as it stood late 2013 to early 2014, right through to the middle of 2014, right to that peak, was the biggest speculative long position in the history of commodity markets. In terms of large speculator positioning, small speculator positioning, and money management positioning, that's right there in black and white in CFTC data. It's the most crowded long trade in commodity market history, and that's exactly what we had right at the highs, which is, the best way to start any bear market is to kick it off with that kind of positioning in place. And this is mirrored. It's a mentality. It's mirrored by what was on the balance sheets, as I noted earlier, for commodity producers. This is just a big, giant assumption that was terribly, terribly wrong. And that led to a number of really good short trades that we had in crude oil for several hundred ticks apiece. And I have pretty much stopped shorting it at this point, and I think that I will start again. And we'll talk in a second about how some of this can be done with ETFs to take advantage of the situation, especially given what we just covered a few minutes ago as far as how Contango and leveraging plays into things, and the fact that you can not only find ways to watch out for the negative effects of this, but also maybe take advantage of it if you're willing to play to the short side. And the next trade, which was the next one in a sequence of really 3 different campaigns, was in copper, which just wrapped up a couple weeks ago when we covered at under 2.5 on CME copper. And one of the interesting aspects of this one, we got into this right around the Thanksgiving time, just before Thanksgiving, I believe, and carried it until several weeks ago. And one of the more interesting aspects of this one is in October, we got word that there was one single hedge fund, a London-based hedge fund, that had accumulated a position in copper on a speculative basis on the long side that was equivalent to, I believe, 60% of all of the free inventory at the London Metals Exchange, which is just, I would call it an absurdly irresponsible position for them to take on. Anybody who puts themselves that big in a market, it's a little bit like what happened to a long-term capital management in 1998 in the Russian ruble. It's when people figure out that you are the market at that point, then that if it starts going wrong, there's no way that you can get out. People won't let you out. And I think that's what we saw in January, is the bid just pulled out of the way and we let it crash. And I think that probably some part of that must have been this London-based hedge fund turning and starting to run for the hills. Okay, so now let's look at where that leaves us. All right, on the one hand, at this point, on the bullish side of the ledger for the commodity complex as a whole, you got bearish sentiment extremes that we definitely reached, that came into place in things like crude oil and copper, certainly in gold and silver. These went from being mysterious blow-ups to being really hated assets. And so that's definitely a point in the bullish column. Another massive point in the bullish column is all of the extraordinary monetary easing going on. We've had something like 15 different central banks cut interest rates or increase stimulus in some manner just over the last few weeks. It's really a remarkable shift, obviously highlighted by the European Central Bank's $1 trillion+ QE program announced last week. So that's another big point in favor of commodities, or at least according to the standard orthodox interpretation of the universe. Another big point is the dramatic fixed cost investment crash. So oil companies aren't drilling, right? Metals miners aren't really opening up new mines or doing much exploration or digging. So the fixed cost side, the expanding production facilities side of things is basically shut down for the time being, which is going to happen anytime you have a commodity bear market. However, on the other side, and just as important, you've got chronic oversupply across the entire spectrum, right? I mean, the reason why there's that dramatic fixed cost investment crash is because we've just got too much of everything, and the reason why you've got this massive currency devaluation and massive stimulus everywhere is because there's just not a lot of demand. So that's another point that's bearish, right? The real demand just isn't there. And then you've got the dollar bull market, which is arithmetically bad for commodity prices. So that suggests, by and large, that we've had this rip-roaring, trending commodity market over the last 6 months, right? I mean, just every day in the same direction in a lot of these things. And that usually doesn't just give way to a reversal and a massive trend in the opposite direction. Normally, what you get after a period of incredibly strong trending, when you get the sentiment extremes and you get the sort of two-sided argument, you get range-bound behavior. And I think that that's what we're going to see over the intermediate term. There's going to be some squeezes and there's going to be some dumps. It's going to be largely, I think, a range-bound market, probably through year-end in the commodity complex. And then, we'll see where we head from there. So given that, and given what we've learned so far today as far as how Contango affects things and the forward curve, and as far as how leverage works, what ETF strategies are going to work best from here? Given that we've got an outlook that favors range-bound behavior after this period of extreme trending action, and given the fact that most commodities markets are mired right now in a long-term Contango curve, right? That includes the precious metals as well as the industrial metals, as well as the energies, the grains, things like coffee. They're all sitting in huge Contango right now. So given all of that, and given what we've learned about how these ETFs work on a mechanical basis, here's my argument. I think you can make a lot of money doing this, and I think this is really the only thing you should be doing with these ETFs at this point. And I know that if you just want to day trade them, that's fine. Place your bets. But as far as coming up with a strategy that is mechanically advantaged right now, given the way these things work and given the way the commodity complex is situated, this is my argument. If I'm starting a hedge fund right now today that does nothing but transact in commodity ETFs, here's what it does. It waits until we get some real squeezing action and some signs in sentiment data of a bullish sentiment consensus in, say, something like crude oil or natural gas. Waits until that moment. From here, in this context, once you get that squeeze and you get that bullish sentiment consensus, then you start building up short positions in leveraged long ETFs while you see that contango in that curve. That's going to take advantage of the contango, use it in your direction. It's going to take advantage of the leverage, use it in your direction, and present an extremely low risk way to generate possibly enormous returns. And that brings us to the Q&A portion of our program here today. So go ahead and send me your questions, and I'll try to answer a few right now. I won't keep you too long live, but go ahead and send any question you want answered, and if I don't get to it now, I'll email you a response. Okay, so first up, I got a question about the as we dig into the outlook for crude oil. One thing that I think a lot of people seem to believe about crude, especially when it was initially breaking down, and we had all the initial statistics about how bad the inventory pileup was getting. A lot of people think of this situation, commodity market, the way that it's supposed to work is when you have a major drop in price, you get a reduction in supply because producers produce less at a lower price, and that's how these things maintain their mean reversion situation. Right? Price goes too low, you get less supply. Right? So as demand pulls out, it reduces supply. As demand increases, supply increases. However, it doesn't really work like that in real time. You're actually making money on any oil you pull out of the ground from any of the wells that you have right now. Pretty much everybody is. Pretty much every well right now is making money on anything they pull out of the ground. And imagine if you're one of these producers and you stop pulling oil out of the ground. All of your competition is going to keep doing it, right? So you're in that situation. You don't want to be the only oil producer that's not producing oil. The price is not really going to go up very much just because you stop, and everybody else is going to keep making money on it and keeping the price down. So in other words, you become the only loser in the game. Now, each one of the competitors in the industry is facing that exact same situation, and they have been for this entire bear market. They're not going to stop producing. Right? They're going to stop investing in expanding their capacity. They're going to stop digging new wells. So you get this big lag. Right now, you're not going to see a decrease in the amount of oil that's coming onto the market. However, the market was pricing, as of several months ago, according to an expectation for the amount of supply that would be coming online over time. Right? So now that we can see that those same investments aren't being made, those same new wells that had been planned to be drilled are no longer being drilled, then we know that there's a shift in the the structure of the supply curve going forward, right? There's not going to be as much supply on a second derivative basis coming online over the course of, say, the next 6 to 12 months. And that's when you're going to start to really see the inflection. However, the market is already starting to take that into consideration, and there's such a buildup of supply that there's a huge hurdle to overcome here. Okay, next, I got a question here as far as the strategy that I outlined on that last slide. If you take everything into consideration, yes, what I'm recommending is to short these ETFs. There is a difference. They're not symmetric in terms of their outcome distribution directionally. If you fade crude at 60 in UCO, all crude has to do at that point, as we've mapped out here, is over the next 4 to 6 months just go sideways. And you're going to make 25%, 30% in UCO. Just guaranteed, right? Just mechanically. Just because of the contango and the leverage. If crude chops sideways after it exhausts the squeeze spike. Now, if crude trades back down to 45 after going to 60, you're going to make 60, 70% in that trade. And there is no way right now that you're going to be able to use ETFs, an ETF-based strategy in the commodity complex that's going to give you an opportunity like that. Shorting leveraged long ETFs with a reference market that's a commodity with a heavily contangoed forward curve after some kind of squeeze off of these lows. That is going to be a strategy that's just about going to guarantee you something like 25 to 50% returns over time. And I don't think you're going to find another strategy that's going to give you that type of return. If you want to be looking for the bounce at this point, there's a lot working against you. Chronic oversupply, major dollar bull market, weak real demand, and basically the central banks of the world having already pretty much exhausted everything that they can do as far as stimulus. That's that's an environment that wants to be deflationary. Okay, so I don't want to keep you guys any longer here. I see some additional questions, and I'll go ahead and answer those back over email. But thank you very much for tuning in, and we'll see you the next time around. Thanks a lot. Take care.